Everyone, let's go ahead here and get started. Welcome if you're new. We in these webinars go through broad market risk. We go through individual stock setups, what positions that we own, as well as ones that we're targeting, so that you're armed with the information to make your own buy plans, or just to kind of understand if we do make a buy, you understand why, or if we make a sell, you understand why. It's just not just some big mystery. I use technical analysis to gauge broad market risk predominantly. We use a slew of other signals. We use some quant signals and, just some, basic like macro fundamental signals as well. But predominantly I use technical analysis to gauge risk. I'm looking for timing windows, and I'm looking for signals of a weakening market, or a weakening trend, let's put it that way, to signal a trend change is underway. And the reason being is because when volatility hits in tech, if you don't have a game plan, you tend to get caught flat-footed and your portfolio's down, 15% from the high, and you don't really know what to do. And so we do this to avoid having those scenarios happen. Anyway, I'm going to start off with some timing cycles to kind of point out where I think we are, just to kind of give you an idea of the inflection point that I think we're at. And then we'll move into some broad market charts and then get into our individual stocks. This crazy looking chart you're looking at is a Gann chart. Gann was the master of timing cycles. And I like to look at charts on a very large time frame, like a monthly basis, weekly basis, to kind of get an idea of these big windows, because these cycles, these symbols all represent cycles that tend to repeat within the Dow Jones. And the Dow Jones has been around since, the mid 19th century. So there's a lot of data to analyze. You can get some really good analysis on cycles that are in play in markets today. And believe it or not, cycles that have been going on for over 100 years are still going on right now. They're still in play. It's a very fascinating and weird world, but an effective world. And so all of these individual symbols are cycles. And what matters is how the trend is going into them. I would say the vast majority of the time, as you can see, the trend tends to reverse going into these cycles. As you can see right here, COVID low, right here into the first correction, that little one right there. And then when they cluster together, it tends to be a more meaningful inflection point. On rare occasions, you'll get a third wave breakout, like right here. You can see this long bar right here is a breakout over this high, signaling an inflection point. But usually you can tell if it's going to be one or the other. And the vast majority of the time, all that matters is how are you trending going into the cycle clusters. I've been talking about the January, February one for well over a year, and it turned out to be very accurate. It was one of the reasons why we were so defensive and had a lot of cash to deploy around the lows. And I've been talking about this October one, this late September, October one, which I'll show you. It's on every single chart that I look at. So this is going to be a big inflection point. Also, October in 2026 is going to be big. These are two huge cycles clustering together, but we're over a year away. So anyway, the other period we were talking about was this kind of July period right here in the Dow. And as you can see, July, August, as you can see, it marked a slight volatility in the Dow, but we've broken new highs. What's interesting, as you're going to see in this webinar, is that this is when the tops began to fall, to start, and they're starting to fall like dominoes. Transports, very important sector, transportation sector, very economically sensitive, tends to lead the broad economy. Top July 10th, and then we'll see a whole host of markets, important markets that topped in late July. And then a lot of very important ones that topped in mid-October, that October 13th, 15th time factor I was talking about. And so, like I said before, though, you'll look at, say, the S&P 500 right here. And though you had slight volatility into these timing windows that I talked about, like late July, October 15th, and now late October, early September, it only had a slight drop. You'll see other markets actually have their tops in those windows. And that's kind of how this thing works. So anyway, if we go forward, the S&P 500 monthly chart was pointing out January, February, and is really, really strong around late September, October. That's going to be a big period. So how we trend into that window is going to be very important. If we're going down into it, huge buying opportunity. If we're trending up into it, caution. But now we go onto the NASDAQ 100 2-week chart, and it's definitely showing the October, it's more in the late October time frame. But it's really strong right now around that mid-October, mid-August, late August time frame. Not only are we seeing a cluster of important cycles as we trended up into it and now have topped into it, but we're doing so into these 45-degree angles at key inflection points. And so we're seeing price and time come together in a meaningful way. And that's important. Small caps, the last cycle I had was around the April low right here. And then the next one I had was right now, late August, early September, this cluster right now that we're trending up into. Same with XLK, which is just, the tech sector ETF. It shows late August, early September, and semiconductors have a pretty big cycle. This green one right here is a pretty big one, and we topped right into it in mid-August. And even ARC, look at ARC. I mean, there's 5 cycles that we clustered into, which marked the most recent top in late July. So anyway, we're in this kind of important period. We're in one of these kind of bigger timing cycles. And so I decided to go back in time and take a look at what happened during this late August, early September timing window. Some pretty significant moments happened throughout markets. This is the S&P 500. I'm going to go to a weekly chart. Let's see here. And so in 2008, the top before the absolute bottom fell out happened right into early September, that kind of late August, early September time factor. We had 1987. That top happened in that same timing window. Going back in time to, 1941, we topped into this one, saw about a 26% drop right there. 1932, we saw a pretty big drop right into that window, very sharp one into that one. And look at that, 1929 happened in that same timing window as well. And then we saw a pretty big drop right here. This is in, before modern markets, but what is that, like 1890s? Yeah, 1890s or so. So we've seen some pretty big volatility. 1929, 1987, and 2008 are pretty big ones. And so when I see like lots of charts saying, okay, this time frame is important, and then I look back in history and see that there've been some pretty meaningful moments happen in this same window, kind of has me on guard. So what I'm trying to express to everyone here is that we're in this timing window. It's pointing towards this kind of late August, early September time frame, and then we get into like the chart patterns are saying, and it all seems to be lining up. So going forward, we're looking at the S&P 500. Now we're getting into more of the price pattern part of the show. And this is a monthly chart. And this is the big trend, right? 2000 to 2009. It's an ABC. It's your secular bear market, but it's very clearly an ABC correction. And we've been in a secular bull market ever since. This is the count that makes the most sense to me. I've kind of wavered back and forth, but based off how this pattern we're in since the 2022 low is unfolding, this totally makes the most sense. And that is from 2009 to the 2011 top. That was wave 1, very sharp and quick cyclical bear market into the October 2011 low. That was wave 2. Wave 3, I'm putting at the 2021 top. We had the bear market in 2022, which is wave 4. And this pattern best fits as an ending diagonal. I've gone over it many, many times. The thing about ending diagonals on all time frames, and this is a big time frame, is once they end, we tend to see a relatively sharp retrace back to the start of them. This has been going on for 2-3 years now, so 6 months or so. It suggests that there would be some kind of a sharp reversal once that ends. But this is the big time frame. I'm saying the secular bull market is closer to an end than a beginning. This is one of the longest ones in history. It's one of the most rewarding ones in history. So based on the bell curve, this is kind of getting into the extremes of how long secular bull markets last. And what follows are always secular bear markets. So doesn't mean, run from the hills. It just means that buy and hold everyone's a genius at making money in the stock market. Time is probably coming to an end once this does end, and it's going to be more of a stock pickers market. I went over this in the last week's webinar, where the last secular bear market, we saw the S&P 500 top in 2000, and it took 13 years for it to reclaim that high. Apple actually went down 80%, and it reclaimed its 2000 top, I think, in like 4 years. And then by the time the S&P had reclaimed its 2000 top, Apple was up over 1,000% from its 2000 top. And the reason I'm telling you this is because passive investing got slaughtered in that time frame, but active investing with a very tactical mindset tends to do very, very well. The reason Apple did so well was not because of macro reasons, but because you can't really stop micro trends. You know, once the iPhone was released in 2007, I mean, yeah, it's a bummer. We had a horrible bear market, just a catastrophic bear market, but it doesn't stop innovation. In fact, it makes innovation more efficient. So anyway, Apple was participating in that micro trend. It was in the first inning of the mobile micro trend in 2007, just before dropping 60%, and it's up like 5,000% since it released the iPhone. And so I'm saying that now because if we do go into a secular bear market, which I think is more likely than not, AI is kind of the equivalent of mobile back then. It's just now starting. And if we do go into some big bear market, I think it will be one of the buying opportunities of our lifetime. And yeah, so anyway, just letting everybody know that. I think our game plan is sound, and we feel quite confident that we'll do well in pretty much anything the market's going to throw at us. So looking in 2022, this is the ending diagonal I was talking about. So wave 4 into the 2022 low. And we had this overlapping kind of mess I've gone over every week, right? So wave 1, wave 2 into the October 2023 low. We had this powerful third wave. Wave 4 was sharp and very deep, and it just barely missed going into wave 1 territory. And now we're in this kind of 3-wave move higher. Now, there's 2 ways that this could end. One is that this is it. Like we're in the final throes of this 5th wave within a 5th wave. If that's the case, we won't really know on the next drop. We'll know on the next move higher. So what do I mean by that? If we do end the secular bull market, the secular bear market will be a 3-wave pattern. Now, 3-wave, it's all fractal. So a small one will turn into a bigger one, into a bigger one, and into a bigger one. And so we're on the lookout for what that pattern might be. Like I said at the April low, I said expect a 3-wave move off this low, and that's exactly what we got. And the small 3-wave pattern turned into a larger one. That's just how this thing works. So the top is in scenario will be a 3-wave move back into this range right here, 5,900 to 5,500, somewhere in there, in my opinion. If we break below 53.45, that's a very big warning. Okay. Now, if we are topping, if I was a top, then the corrective bounce off of that first move lower will also be a 3-wave move, which will make a lower high. And that's going to be kind of your final attempt to kind of prepare for things getting really bad. Okay. It's usually not that easy, but it's, that's basically what we're looking for here. We're going to get 3 waves down likely. And once that bottoms and we get a corrective bounce, whether it's shallow or big, what that bounce will be is going to be very important. If it's 3 waves, then we're going to get super cautious. Okay. The other scenario, which is what I think is playing out, is my green count. Okay. Which, look at how long this first wave was. It was from October 2022 all the way to August of 2023. So almost for an entire year. This one right here is April 2025 to August, right? So the proportion is kind of off. You can even visually see it, how long wave 1 is compared to how long wave 5 is. What would make more sense is that we get a 3-wave drop into here, into this zone I'm talking about, and then we get a powerful move higher, like a 5-wave move higher to new highs, 71, 72, 74, something like that into 2026. that would make the most sense. But we won't know if that's going to be in play until we drop and then get our bounce higher, like the corrective bounce. If it's a 5-wave move off that low, then we're in business. And that's something that we would want to be heavily invested in. Okay. So I know the game plan has somewhat changed a little bit. We were expecting the first drop to be either 3 or 5 waves, but we've gone to new highs. We've not only gone new highs, but we've gone noticeably over new highs. And so I think that original, the top was in a January, February count, though it's still active. If we get a 5-wave drop from this high, that's a big deal, but I think that's less likely right now. So, anyway, hope that made sense. Now we're going to dive into where we're at right now. Okay. S&P 500. This is off the late May 2025 low right here. And so follow my blue count. This is what I think is in play, something like this. It's a diagonal for wave C, for the C wave. So 1, 2, 3, 4, and then we have a 1, 2, 3, 4, A, B, C for 5. It's just kind of an ending diagonal pattern for this ending diagonal pattern that's in play for wave 5. So 1, 2, 3, 4, 5. And the 5th wave is an A, B, C. And so we have everything in place. All waves are accounted for this very long, drawn-out pattern. We're at the 6,500 level, which is one of our targets. Could we go to 66? Of course, we can go to 66.5. Really bad idea to try and short a market at all-time highs. Better idea is to wait for support to break. That's your best option. And based off of this pattern analysis, we kind of know what levels have to hold in order for this pattern to continue. And so the first level right now is 64.30. Below there is your first warning that this pattern is coming to an end. Then below 63.52, that's your next warning. And each level that breaks is going to be more risk is being introduced into this market. Then 63.03, I think, is pretty much below there, and there's no pattern that's going to take you higher. 62.10 is it. So those are a lot of levels to work with in order to manage risk. I don't think shorting a market pushing to all-time highs is a good idea, even with divergences, even going into a timing window, even with everything I'm telling you and about to show you to support this. Waiting for support to break is going to be your best bet. And those are your supports to break with. Like, let's say that we're moving down to 5,900, knowing that the odds are increasing at 64.30 is pretty good. Knowing at 63.50 is also really good. So those are good levels to manage risk with, considering what kind of correction we probably have in play. Now, the scenario I have, and it seems kind of, to me, it seems less likely, but just based off the pattern, I had to kind of squeeze it in. But I'm trying to account for all scenarios. If we drop into 63.03, 62.10, and hold 62.10, then there's a chance that we could just push higher into October. That October time factor I told you about, that cycle window, the really big one, that's what that would probably be. Some kind of a drop into here, and then we get that final push into October for wave 5. So anyway, as long as we stay above 62.10, I see that as a possibility. All right. So moving forward, the S&P just broke to new highs. Now take a look at this. These are important markets. These are markets that I track when they're all trending in the same direction. That's a very powerful trend. And when they all start kind of diverging, where one's pushing higher and others are not, it's a pretty weak market. And until those divergences correct, I consider that to be a warning. Not every period of divergences leads to some kind of a correction, but every correction is preceded by these divergences, if that makes sense. So anyway, transports, they topped in July 10th. All right, that's a long time ago. Financial conditions topped in late July. High beta, your high beta, which is really leading this market, topped in late July. The equal weighted Mag 7 they topped in that October 13th, 15th time factor I was talking about. Semiconductors, which have been market leaders, also topped in August 13th and 15th. And now we're seeing the equal weight S&P 500 not participate with the S&P 500 today, making new highs. And so the only markets that are really pushing to new highs right now is small caps. There's a lot of divergences that have been going on for a long time. It's kind of like falling like dominoes. And when I see things like semiconductors and the Mag 7, which have been market leaders, when they are not participating at new highs, usually a pretty big warning. Okay. Getting into small caps, which has been relatively strong, and people are talking about small caps just leading the way from a technical perspective. I keep pointing to this chart. This 65 level on the 3-day RSI is pretty important. You can see how we can't seem to break above it. Why is this level important? This is where the February top occurred at that level. This is where the 2021 top occurred. And it was also the level that marked the gap, the third wave breakout in 2020 that led to one of the greatest runs in small cap history. So this right here was the breakout, and it's been used as resistance for pretty meaningful drops, even right here in July of 2023, right there. So the fact that it's just getting stuck there as price goes higher, not great. And then if you look at the composite index making lower highs, while the RSI is getting stuffed underneath that major level, all while volume is decreasing as we go higher, it's not ideal. And then you factor in that it's trending up into this cluster of time cycles. Yeah, I mean, so I'm pointing that out because you can look at that and say, oh yeah, small caps look great. They're going up with the S&P, but everything I see from a technical perspective is flashing really big warning. So anyway, just pointing that out.